You don't need $2 million to own a shopping center. Most people think commercial real estate is reserved for the ultra-wealthy. But there's a hidden vehicle that surgeons, engineers, and high earners use to acquire massive assets without the management headache. We've analyzed hundreds of passive income strategies to find the ones that actually scale without taking over your life. We specialize in the hidden side of real estate, the institutional-grade assets that usually stay behind closed doors. In this video, I'm pulling back the curtain on commercial real estate syndication. I'll show you how to own a piece of a multi-million-dollar complex with as little as $25,000. We'll break down why this beats a standard REIT, how the tax advantages work for high-bracket earners, and exactly where to find these vetted deals. If you want the wealth of a landlord without the 2 a.m. phone calls about a leaky toilet, you're in the right place. Look, you've done everything right. You've climbed the ladder. You've got the high salary. But you've realized something frustrating. You're trading your most valuable asset, time, for a paycheck. You want the wealth that comes with commercial real estate, the kind of assets that pay you while you sleep. But then you look at the reality. First, there's the landlord trap. You don't want a second job. You don't want to deal with midnight emergency calls or chasing down tenants for rent. You're a surgeon, an engineer, a specialist. You don't have time to be a property manager. Then there's the capital wall. To buy a quality apartment complex or a retail center on your own, you need millions. Even with a loan, the down payment is staggering. So you look at rates. But REITs are basically just stocks. They're volatile. They don't offer the same massive tax advantages as direct ownership. You're stuck in the middle. You have the capital to invest, but not the time to manage, and not enough to buy the big assets solo. Your money is sitting in a low-yield account or a volatile index fund, while the ultra-wealthy are quietly buying up the block. It feels like there's a club you're not invited to. But there is. The secret is called real estate syndication. In simple terms, it's a partnership. Instead of you trying to find, fund, and manage a $10 million asset on your own, you pool your capital with a group of other investors. This allows you to own a fractional piece of a massive commercial property for a fraction of the cost. Usually, the entry point is around $25,000 to $50,000. Now, to understand how this works, you need to know the two types of players involved. First, the general partner. This is the operator. They are the experts. They find the deal, secure the financing, and handle the midnight phone calls when a water pipe bursts. Then, there's the limited partner. That's you. As an LP, your role is simple. You provide the capital. You don't manage tenants. You don't fix toilets. You don't deal with zoning laws. You simply collect a share of the rental income and a piece of the profit when the property is eventually sold. But why do high earners, like doctors and engineers, prefer this over just buying a few rental houses? 2 words: scale and taxes. First, scale. Managing 5 single-family homes is a part-time job. Owning a piece of a 200-unit apartment complex is a passive investment. You get the benefits of institutional-grade real estate without the operational headache. Second, the tax advantages. This is where it gets powerful for high-income professionals. Through a process called accelerated depreciation, you can often offset the cash flow you receive from the investment. In many cases, you're making money on paper, but your taxable income actually goes down. Now you might be thinking, why not just buy a REIT? REITs are great, but they're essentially stocks. They are volatile and trade on the public market. Syndications are direct ownership. You have a K-1 tax form and a direct claim to a physical asset. It's far more stable and offers significantly better tax shelters. But here is the warning. In a syndication, you are trusting the operator with your money. If they are incompetent, your investment is at risk. You must vet the general partner, Look for a proven track record. Ask how much of their own money they are putting into the deal. If they have no skin in the game, walk away. When done correctly, this is the ultimate wealth vehicle for the busy professional. You leverage someone else's expertise to build a portfolio of assets that would otherwise take you a lifetime to afford. Now, finding a trustworthy deal is the hardest part. You can't gamble your $25K on an unproven operator. That's why I recommend the vetted syndication platforms linked in the description. They do the due diligence, so you don't have to. Imagine this. You're at your clinic or your engineering firm. While you're working, your share of a 200-unit complex is paying you monthly distributions. Plus, because of cost segregation and depreciation, you could potentially pay zero tax on that income. To maximize these savings, I've linked a top-tier tax strategy consultancy. Below that specializes in high-earner wealth preservation. Stop trading your limited time for every single dollar. Hit subscribe to master your passive income journey, and click the link in the description to start browsing vetted deals today. Let's build that legacy.